We continue with a question. What, if anything, does this case say about the need for increased financial regulation of the banking system? We pick that up with Michael Greenberger, professor at the University of Maryland School of Law and a former federal financial regulator, and Bert Ely heads his own consulting firm specializing in banking, monetary policy, and financial regulation. Well, Michael Greenberger, I'll start with you. So that's the question. Was this just a bad mistake, or does this say something about a more systemic problem?
Well, this is not, thank goodness, appearing to be a systemic problem. In other words, we're not going to have to hopefully bail J.P. Morgan out. But as Liz Rappaport said, these were supposed to be the brightest guys in the room. And if you listen to Jamie Dimon explain this thing and call it egregious, sloppy, et cetera, that is the signal that's being sent. It's at a minimum a canary in the mine saying that these complex instruments are not even well understood by the people who create them and trade them.
And therefore we need more regulation?
Well, we don't need more regulation because actually the Dodd-Frank statute, which was signed into law in July of 2010, if it is ever allowed to go into effect, and the banks have been very tough in keeping it from going into effect, would have 6 ways from Sunday stop this kind of trading. And there's legislation pouring through the House right now to undo Dodd-Frank. Presidential candidate to be Mr. Romney, one of his pledges is to repeal Dodd-Frank. And so he's asking the American public to go back to a situation where the profits that are made on these, and they can only be called bets in my book, are kept by the bank. The losses, if they're extreme, must be made up by the taxpayer.
All right, Bert Ely, what do you see? Does this suggest that the need for Dodd-Frank?
Well, I think the real issue here is with regard to the so-called Volcker Rule in Dodd-Frank. Dodd-Frank is a very complex piece of legislation, so I think it's important to focus in on what's at issue here, and that's the so-called Volcker Rule, which is intended to provide a basis for more closely regulating the derivatives activities and other financial trading activities of the banking companies. The problem is that the regulators are having an extremely difficult time figuring out exactly how to write the rules to implement the Volcker Rule. And I would contend, I think Michael might disagree with me on this, that I don't think an implemented Volcker Rule, and it will be implemented eventually, would have prevented this type of situation because at least on the surface, these derivatives that the London Whale entered into were meant not to be, were really meant to basically protect the bank against losses on loans and securities. And as I understand, the Volcker Rule would have been outside the focus of that rule.
Well, does anyone understand this? Because as I read it, so much seems to rely on the terms hedging and proprietary trading.
If that question can't be answered, you've got a real problem. If you ask me, am I hedging in my life? Yes. I buy automobile insurance to protect my car being totaled.
So you say this case, it's clear that
Jamie Dimon or J.P. Morgan can't clearly explain how they were hedging. They'd like to say they were hedging because that makes it more forgivable. If there are doubts, if you can't clearly say, I've got a credit default swap to protect me against the failure of a company I've lent money to, that's a hedge. Trying to bet on a 121 company index, the Volcker Rule will go into effect, and when it goes into effect, if you can't explain that you are making a market clearly, if there are doubts, if there are questions, if the PBS NewsHour is confused, that's going to be found to be in violation.
Now, I don't know about the PBS NewsHour, but you don't seem to be clear that this case would have been different if the Volcker Rule was in place.
I don't think it would have been different. One of the things, and Michael's really kind of touched on this, is there are differences of opinion, legitimate differences of opinion about the purpose a particular hedge is serving. And I think what happened in this situation is that an idea that was good in concept and good up to a point was taken to extreme. And Liz touched about how he was dealing in particular instruments and the market became very illiquid. He became too big a player in the market. That's, in effect, why he was the whale. And this reminds me of another situation back in 1998 when a company called Long-Term Capital Management blew up. Big difference there is that there was great concern at that time when long-term capital management had its problems that it might shake and rattle the whole financial system. The good news about this situation is that as big as that loss is, it was one that J.P. Morgan Chase could handle internally and bear all of the loss.
All right, but in layman's terms, there's still this too big to fail question, and we heard it in the setup from Senator Levin. Is this a case that suggests to you that
yes, the purpose of the Volcker Rule is to get bank holding companies that have our deposits that are insured by the FDIC or the American people and who have the ability to turn to the Fed in a crisis and get themselves bailed out. What the Volcker Rule says, we don't want you engaging in reckless transactions, egregious, sloppy transactions, to use Jamie Dimon's word, because you're using the taxpayers' money. So we're going to take you and say, you can't do this kind of trading. If you can't clearly explain to me this is a hedge, you're out. Now, by the way, it's not just the Volcker Rule. There's something called the Lincoln Rule, which would have prevented this trade because it was an uncleared credit default swap, therefore unsafe. And also, there's a whole measure of clearing, transparency, capitalization, collateralization. None of these things were present. If this were transparent, the regulators would have known about this when the Wall Street Journal was reporting about the London whale weeks ago, and they would have put a stop to it before it was a crisis.
What about my question about are the banks too big? Does this tell us anything about whether something more needs to be done about the too big to fail idea?
I am not as concerned about the so-called too big to fail problem as many others are. One of the things that becomes a problem is they say we'll break up the big banks. Well, the question is exactly how do you break up the big banks? I have yet to hear a credible explanation on that. But here's what also concerns me. The more you try to zero regulation in on the banks, number one, you raise the question of are the regulators up to the job? But to the extent that you try to squeeze in on the banks, it's like squeezing a balloon. What will happen is a lot of these transactions will move out into what is called shadow banking, into a less regulated world. And if they blow up there, they might in fact blow up the whole financial system.
Well, that's a horrible place to stop, but I have to stop there. Bert Ely and Michael Greenberger, without blowing up the whole financial system. Thanks so much.